holidays with friends and family. And Ian, what's the best part of the holidays for you?
For me, it's a chance to reflect on what the year did for me and for others, and also to really feel gratitude that I'm still in the game, and hopefully many of you are still in the game, and look forward to always learning more from others, sharing their experiences on the podcast. It's been valuable for me, and I hope it's been valuable for all of you.
Yeah, and for me, it's just, being able to slow down and take it easy towards the end of the year. Especially in my case, with my family staying with us for the holidays, it's a great opportunity for me to be present, to be more present. Because you know how being present can be the hardest things to do, to just, even put down our phones for just 55 minutes straight can be so challenging. But I learned that just the simple act of being present can be the greatest gift that you can give to those around you that you care about. And it's a gift to yourself too. Well, Ian, I've had a blast this year co-hosting with you and really appreciate you. And I'm truly excited about 2024.
Yeah, thank you, Tessa. Yeah, 2023 was quite fun diving into the minds of different traders, hearing both great victories and tragedies in their trading performance. And I look forward to upcoming interviews as well. We've got some interesting people on deck for 2024. So definitely would love to see more of you in the community sharing your ideas and look forward to connecting with all of you in there as well.
Yes, we want to give this shout out to our Chat with Traders community members that you guys are so awesome. And it's personally really exciting for me to witness your transformation in your trading journey. And it's very inspiring. We built this community with the primary goal of connecting listeners and traders with each other and to trading related resources that can help our members in their trading journey. If you're interested, you can request complimentary access to the community. Just head on over to the Chat with Traders website, chatwithtraders.com/community, and we hope to see you soon. To our listeners, happy holidays, Merry Christmas, farewell 2023.
And looking forward to 2024, hearing all your stories and sharing your experiences with us.
Yay, let's go 2024. Trading Challenge led by Patrick Peterson, who was featured on episode 260, and Steve B., one of our hosts inside the community. This is in partnership with Darwinix. If you are interested in attracting investor who was featured on episode 260, the first one.
Casey Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and
Community Trading Challenge led by Patrick Peterson, who was featured on episode 260, and Steve B., one of our hosts inside the community. From your own trading and gaining more, where you will learn about the Community Trading Challenge program and learn how you can participate in this healthy competition with other traders, where you can learn, improve questions. How do you participate in these events that I just mentioned? Easy. Just join the Chat with Traders
process, but it's not my job to say what the Fed should do or to invest in accordance with what I believe the Fed should do. It's my job to make money on the basis of what the Fed will do. If you just look at the technology that is available to the public today, call that ChatGPT-4. If you assume that ChatGPT-4 is where AI technology stops, there can be no progress beyond that. That technology in and of itself will change everything 5 times over.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey traders and listeners from all over the world. Welcome back to Chat with Traders. And if you're new to this podcast, a big welcome to you. We are on episode 273. I'm Tessa, your co-host. And Chat with Traders has been a great source of information, inspiration, a place that brings different perspectives, sparks ideas, and important discussions for all things related to trading through the lens of our guests that we bring onto the show. And at times, we also enjoy deviating from our core topics every so often just to shake things up a bit. We're excited about what this new year brings to our podcast, and we really hope that you're all doing well. Hey, cheers to a fresh start and a new year full of exciting possibilities for you. Wishing you health, wealth, and success, whatever success means for you. Happy 2024 New Year. Today, to kick off the new year, Ian interviews our first guest of the year. His name is James Fishback. James is the co-founder and chief investment officer of Asoria Partners, a global macro investment firm. Prior to Asoria, he served as the head of macro at Greenlight Capital, a $2 billion hedge fund led by David Einhorn. James is also the founder of Incubate Debate, America's fastest-growing high school debate league. As a former national high school debate champion and volunteer debate coach, he launched Incubate in 2019. James was fortunate to have the opportunity to display his talent and strategies to the well-known billionaire hedge fund manager David Einhorn, which also resulted in James getting exposed to new ideas and ways of looking at economies and markets. Unwilling to repeat the same mantra commonly put out by the financial media, James presents a fresh look why the economy and the markets have multiple silver linings. Please note, we at Chat with Traders do not endorse any specific political viewpoint on our podcast. Now, without further ado, ladies and gentlemen, we are so pleased to present James Fishback from Florida.
Well, James, how you doing? Where are you at right now?
I'm doing good. I am at home in Madison County, Florida, which is about 50 miles east of Tallahassee, 20 miles south of Georgia. I actually grew up in South Florida, in Fort Lauderdale. Was there until I was 18, went off to college up in Washington, D.C., and have been back to Florida since leaving D.C. in college.
Well, okay, great. And what kind of topics did you study in school, and what was your area of interest?
My technically my major was international economics, but I did a lot. I dabbled in a lot of cool classes. I took classes on the Second Amendment, on comparative politics, on history, the Civil War. So I tried to make the most of my college experience by trying to get many different perspectives and courses in.
When did you first get into investing or trading?
It was about the sophomore year of college. I was doing some undergraduate research with a professor and looking at the time, equity volatility and spending a little bit of time trying to wrap my head around that. not easy stuff for being a couple years out of high school, but I was just fascinated by the idea, the puzzle, the challenge that it presented. And so I started getting involved. I went to a family friend who was a pretty wealthy individual who I connected with during high school debate. Her son and I had competed quite a bit on the national circuit. And I said, "Hey, I have this idea. I've been doing this research for a professor, and I'd love to try to make some money for you off this idea." And to her credit, she gave me a little bit of money to work with, and fortunately, that idea worked. And we spent the next year building out a portfolio of different ideas in a number of different markets, and that was really the beginning for me in a very earnest way.
What kind of idea was that, if you could share?
Sure. So this was the summer of 2014, and so equity volatility in the U.S. was awfully low. Currency volatility was awfully low, and so it was just really thinking about how long that dynamic was going to persist, and then if it did end up unwinding as it did in late fall 2014, what would that actually look like? So a number of different trades to take advantage of mispricings in the term structure, in some cases vol being too high, in some cases vol being too low. And as there was a flash crash, I'm sure some folks will remember there was a flash crash in the US Treasury market in October of 2014. And that's really what kicked a lot of the vol higher and made this idea work out.
I've noticed in many of your previous interviews that you like to spend a lot of energy focusing on economic issues, and I'm curious what makes economics interesting for you.
What makes it interesting for me is you never really understand it. It's constantly changing. There's always something new going on. I mean, take today, for example. Today's January 5th. We had a big jobs report at 8:30 here in the US. At first blush, it was stronger than expected. So the bond market started to sell off because the market had priced in a lot of easing, a lot of cuts from the Federal Reserve. And so the thinking was, hey, we get a strong jobs report. That maybe means the Fed doesn't need to cut 6 or 7 times as the market is pricing. And so that's exactly what happened. The bond market sold off, started to take away some of the cuts that were priced into the market. And then an hour and a half later, we have an ISM non-manufacturing release, which shows that a survey gauge of employment was actually at the lowest level since July 2020, and that spooked the market. And so all of a sudden, in just a matter of about 5 to 10 minutes, you unwound the entire sell-off in the bond market and then added some on top of that. And so for me, it is the challenge of anybody can look at the data. There's a piece of data in the economy in some way, shape, or form that can tell the story that you want to tell. That can find some piece of data that shows uber pessimism and one piece of data that shows that inflation is going to 10% in 6 months. What's tricky, Ian, is how do you weigh the data? Which data is more important than others? And how do you look at data comprehensively to tell a bigger, more objective story about what's going on? Now, of course, as your listeners will know, as you will know yourself, Ian, when we're investing, when we're thinking about global macro as a trading strategy, we're not necessarily trading the data. Very rarely are we saying, well, this position will as a necessary fact, this position will do well if inflation goes lower. No. This position will do well if the jobs report comes out higher tomorrow. No. There is a reaction function. And so when we think about economic data, we're viewing it from the lens of what the Federal Reserve will do with that data. And so one thing that I'm constantly reminded of is that to really invest on a macro basis, you don't just have to think about the data. You actually think about how the number one actor in the markets, the Fed, is going to react to that data. Because if they're going to ignore the data, I mean, let's think about it. The Fed cut to zero in December of 2008, didn't hike rates for 7 years until December of 15. And so pretty much no matter the data release you got, great jobs, poor jobs, whatever, the very, very front end of the treasury market, call it the 1 year or the 2 year part of the curve, 2 year treasury yields, were almost always muted as a result of the data because you got the data right, but the Fed was stuck at zero and stayed there for years. And so it's about balancing those two.
But frequently, we don't get updates from the Fed every week, right? On how they interpret the data. Isn't there a lot of kind of guessing going on of like, well, based on past history, Chairman Powell doesn't really look at these types of economic releases, and so we're going to presume that he's not going to look at it this time that much anyway, right? And then isn't it a lot of kind of guessing in between the Fed meetings?
It absolutely is. And a lot of it too, Ian, is what the market thinks is important for 5 minutes may not be important 35 minutes later. And so there's this great quote from a couple of years ago that high frequency traders, which represents an increasing share of the market these days, that high frequency traders know the price of everything but the value of nothing. And so you could get a data release that has little to no impact on what the Fed will do at, say, the March meeting. And yet the market will whipsaw, be that the stock market, be that the currency market, the interest rate futures market, will whipsaw on some data release. And all of a sudden will obsess and say, this is it. And yet here we are. And actually half an hour, 2 hours the next day, we've completely retraced the move and then some. And so I've found a lot of value in terms of a trading strategy in thinking about fading the extremes. When the market misunderappreciates, I'm coining that word here, when the market misunderappreciates or misoverappreciates a particular data point, and you know that the Fed has historically or hasn't really mattered for the Fed, and that's a really interesting dislocation to take advantage of.
So I understand that you worked with the famous David Einhorn.
I did.
Anything that you learned from him?
Yeah, I learned a great deal from David. I was working at the time, was running my own fund in the spring of 2019, and I saw David was talking about the Fed in an interview, and so I pinged him on Bloomberg. I said, this Fed meeting is they say they're not going to cut, but if you look back at the 98 playbook, the 1995 playbook, it actually looks like there's a real chance for them to cut if the trade war continues on the path it's going. And so we structured a couple of trades around that view. And to David's credit, he put them on, put a trade on from a random kid who had reached out to him over Bloomberg, and those trades worked out. And then so over the course of the next nearly 2 years, I had the opportunity to work with him externally to build out a macro portfolio for Greenlight to help think about, okay, what are some really interesting trades, but more importantly, actually, how do we go about structuring those trades? And had a really great run of it. And then at the end of 2020, he said, we had a good time working together. Do you want a job? And I was blown away. I was given the opportunity a month or so later to join Greenlight and to run the macro investing unit within the firm. This is a firm that historically, as you know, Ian, is what's called the long short equity hedge fund. They think about questions like, is Apple going to go up? Is Tesla going to go down? And so I got the opportunity to come in and work directly with David to think about other questions. Is the Fed going to be hiking rates in the second quarter? Is inflation going to be above or below 4% over the next year? What is the oil market going to look like? What is the European Central Bank going to do? What impact will Russia's invasion of Ukraine have on natural gas markets in Europe? And so an entirely different set of questions I got to ask at a firm that for the past 25 years was just focused on the stock market. So I learned a lot. I think the biggest thing I learned from David was to keep it simple all the way. It's really easy to want to be creative, to want to think about structuring an investment in the most peculiar way possible. But this is not for folks who want to do creative writing. This is for people who actually want to see their ideas pan out and make money. And so the worst thing that can happen, I think, is you're right. You made the right call, but you actually ended up losing money because you didn't end up structuring the trade. And I don't mean this to say you bought the wrong thing, but you maybe did a particular option structure where your exposure to the underlying changed with time or changed as the direction of that underlying went in a different direction. I'm reminded of a quote by Stan Druckenmiller where, there's something in the options market, in the exotic currency options market called a knockout option. And the idea is, well, look, the euro right now is 112. I think it's going to go higher. So I'm going to buy a 115 call with a knockout at 118. And so, Ian, what that means is if you're right and the euro goes higher, you make money. But if you're really right and the euro really goes higher, then you make nothing. And so this is the type of creative cuteness, too cute by half, that David was really against in principle. And so it was cool thinking about, okay, cool. How do we have the right thesis? But then how do we really go out and operationalize that? And so I was spent a lot of time doing that at Greenlight.
So rumor has it that you like lemon head candies. How are these treats metaphors for the Fed and the economy?
Yeah, I do. It's one of those rare times where you get to talk about your childhood in this business. And lemon head candies are these little candies you suck on. You put them in your mouth, and the first thing is this burst of sour. That's the first sensation, is this burst of sour taste, lemon taste. And then as you suck on them for a minute or two, they become sweet. And so think about that, Ian. You put them in your mouth, sour, and then after a little bit, they become sweet. The Fed starts hiking rates in March of 2022. Then they go 25 basis points a meeting, 50 basis points. June comes around, they're doing 75 basis points a meeting. They do 75 basis points for the next 3 consecutive meetings. Stock market doesn't like that very much. Credit market doesn't like that very much. That's the sour. And then 2023 comes around after the stocks are down 20% the year prior, after all of this tightening from the Fed, the most aggressive pace, by the way, since the Volcker days. And things start to change. The economy actually starts to look better. The pessimism gets defied at every single term. As Nick Timmeros in the Wall Street Journal wrote earlier last year, it seemed like the recession was always 6 months away. And the reason for that is because in today's economy, the way that the US economy is structured, higher rates does not necessarily mean lower growth, more unemployment, and less inflation. In fact, it means the opposite. And here's how. If you're a business and you've got two sides of the balance sheet, you've got your assets, you've got your liabilities. If you've termed out all of your liabilities to the point where you have no exposure to floating rate debt, like Microsoft, Apple, or Google, you have no exposure to floating rate debt. The Fed could hike rates to 30%, and it's not going to have any impact on how much you pay in interest servicing costs. On the contrary, actually, as the Fed was hiking rates aggressively, Ian, what happened? Those businesses who had all this cash parked on the sidelines, they started making real money with that excess cash. Same thing with households. The vast majority of mortgages in America are 30-year fixed rate mortgages. And so when folks either bought homes for the first time or refinanced, we're one of the 14 million homeowners who refinanced in the 2 years around the pandemic, they locked in low rates, not for 6 months, not for 9 months, but for 30 years. And so when the Fed came around to start hiking aggressively, there was no impact to their interest servicing costs. It was a 30-year fixed rate mortgage, fixed rate for 30 years. But what did happen? Well, all that stimulus that came out of either the CARES Act or the American Rescue Plan, all of that stimulus was sitting in bank accounts that was now being moved to money market mutual funds and now earning 5%. And so for the first time in a quarter century, American consumers were being paid a real amount of money to hold cash. And that was supporting consumption in the economy. And so the Econ 101 would tell you, wait a second, the Fed hike rates a lot, so the stock market has to go down. And so we're going to have to lose jobs and everything's going to come to a screeching halt. And if you would have told me that, I think if you'd have told most people that the Fed's going to go from 0% to 5.25% at the fastest rate in 40 years, is going to hike 75 basis points at 4 meetings back to back to back. It's going to draw its balance sheet down as well over this period. I would have said, well, most people would have said, yeah, unemployment's above 5%. Not actually, unemployment's 3.7%. And we added 3 million jobs over the past year. And we had almost 5% third quarter GDP growth, and retail sales knocked it out of the park, and so on and so forth. And so at the end of the day, the lemonhead problem for the Fed, succinctly put, is interest rate hikes are not having the effect that the Fed intends. They're not having the effect, much like, by the way, the rate cuts from 2008, 9, right? That entire period of quantitative easing, that monetary stimulus was not having the effect that the Fed wanted. The Fed wanted to use quantitative easing, use things like Operation Twist and 7 years of zero rates to boost the economy, to increase job growth. What did we get, Ian? We got the weakest recovery in the post-World War II era. And so the Fed has a track record of wanting to do one thing and actually getting the opposite effect. And so David Einhorn, my former boss, coined this theory called the jelly donut hypothesis, which was that the first jelly donut, like the first rate cut or the first 100 billion in QE, is a delicious afternoon snack. The second one is good, but not quite as good. The third one, it starts to wear off. The fourth and fifth one, stomach ache, and the fifth and sixth, I know it's not politically correct, but they're eating disorders, right? And so much like those additional jelly donuts went from having a much smaller marginal benefit to a negative benefit, the Lemonhead has gone from being what was perceived to be a negative for growth and employment to, in many ways, supporting the very thing that the Fed actually wanted to slow down.
Chat with Traders is brought to you by Trade the Pool. Are you a developing or seasoned day trader who trades the U.S. markets? Is the only thing stopping you from getting to the next level is having enough capital to trade? Trade the Pool is a unique online stock trading prop firm that funds stock traders worldwide. Not having to risk your own capital can help you focus on other things like making better decisions on your trades. There's no PDT rules to worry about. You got more than 12,000 stocks and ETFs to trade, long or short, and professional tools at your side. How you get funded is you show them your skills through a straightforward evaluation process. Once you pass the evaluation, you get funded and trade with their pool of money and split the profits. As a funded trader, one-on-one coaching, guidance, advisors, and mentors are included. Don't let the lack of buying power, capital, or fear of losing your own money prevent you from taking your trading to the next level. Visit tradethepool.com/chat to learn more. You want it done right, so trade it yourself at Tasty Trade. Stocks, options, futures, and more all in one place. You choose, you trade. Plan moves with risk analysis tools and hundreds of charting indicators. Become a smarter trader with options education, plus research and news features. Make moves in just a few clicks on mobile, web, or desktop, supported by a trade desk that knows what makes traders tick. The tools, the data, the knowledge. Get what you need to make smart moves. Go to tastytrade.com/pod and see for yourself, genius. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Chat with Traders community now offers its own live trading room with professional day traders Patrick and Steve. Patrick, a former guest on episode 260, now trades for a leading Swiss hedge fund. He has been inspiring and guiding newer traders to take their trading to the next level. With over 17 years of trading experience, Patrick is a passionate expert in the markets. His live trading room partner, Steve, is a funded trader with multiple prop firms. He efficiently manages his own trading accounts, and he has been consistently profitable for the past 2 years. Both traders bring their unique focused trading styles in the live trading room. All their trades are executed in real money accounts with complete transparency in performance. If you are interested in observing their trading techniques and gaining valuable insights during the U.S. morning session, we invite you to join Patrick and Steve in the private live trading room of the Chat with Traders community. Being in the presence of professional traders and observing how they trade can be a very valuable part of your learning experience. For more details, please visit chatwithtraders.com/community. So the old mantra, don't fight the Fed, is that now dead? I mean, is this situation you're describing quite unique in history that we can say, oh, okay, well, this time truly is different for these variety of factors that you just mentioned. And in a normal situation, interest rates go up, you should sell the market because, I mean, after all, we look at the market today and it's higher than it was in the bubble times of late 2021, yet interest rates are still higher. What does that say? Are we having a kind of a melt up market? I mean, what's driving this market to new highs, despite the interest rates being high and quantitative tightening in effect?
Yes, it's a good question. And the fact that the market has done as well as it's done since early November, as rates started to come off, but especially since that last Fed meeting, it's raised a lot of questions and a lot of eyebrows. I think the biggest thing is that this time in many ways is different. And I know that people will latch onto that phrase one way or the other, and they'll say this time is different without any credible evidence. And then they'll say, no, it's not. This time is never different without any credible evidence. Well, allow me, if I may, to present that credible evidence, because I'm a former high school debater. And so I think about the evidence that you actually need to make these points. And so here's just the facts. Over the period that the Fed was raising rates, corporate net interest payments in the United States have gone down 5 quarters in a row and are now down 25% from where they were when the Fed began raising rates. And so rates higher, yet net interest payments lower is the textbook definition of a paradox. It's like saying you're going on a diet and you're doing all this exercise and you're eating all these kale chips, but you're actually gaining weight. And so it's difficult to see the Fed meaningfully bringing down inflation from here. And by the way, we're still well above the Fed's target. Yes, we're well off the 7, 8, 9% highs of 2022, but the Fed's inflation target is 2%. To get the type of return to inflation at 2%, you really need to see demand destruction. And you're not seeing that in this environment. The economy has actually surprisingly held up well, given high rates. The question of whether the Fed is going to cut rates in 2024 is actually less of a economic question, to tell you the truth, and it's more of a political one. I've never believed the idea that the Fed is some independent body just because they say so. You know, the DOJ says they're independent. The FBI says they're independent. The IRS, which when it was auditing conservative organizations under President Obama, swore they were independent. So your independence is not so just because you woke up one day and said you're independent. Your independence has to be earned. And I got to tell you the truth, Ian, the Fed has not earned one iota of independence. And here's why. Just one example. In 2019, when the Fed was thinking about cutting rates, same time that I was talking to David Einhorn, the first time we had worked together, the Fed was thinking about cutting rates. It was at this very time that the former president of the New York Fed, he had just retired a year earlier, Bill Dudley, just at this time where he said in a public opinion piece for Bloomberg News that the Fed should not cut rates because it would help President Trump get elected. That is exactly what it was. And so for me, when I think about something like that, someone who was just in the number 2 position at the so-called independent Federal Reserve, going out in public, imagine what he says in private, going out in public and saying that the Trump presidency represents a threat to the global and boost Trump's chances in the 2020 election. Take it a step further. That's just one example. Let's take it a step further. For every Republican economist at the Fed, there are 10 Democrat economists. 10-to-1 ratio. Take it a step further than that, Ian. $900,000 was donated from Federal Reserve staff to political campaigns in the 2020 election. 97% of that went to Democratic candidates and causes. That's higher than Harvard University. 97 cents of every dollar in Fed donations went to the Democratic Party. And so whether they want to think they're independent or not is not even the point. Maybe they genuinely do believe they're independent. But just like our universities have sworn that they are independent, you can't be independent and can't have diverse viewpoints when 9 out of 10 of your staff members are of a political party, and when 97 cents of every dollar of your political donations go to that political party, and especially not when the number 2 at the entire Federal Reserve System says, well, you can't cut rates, it's going to help Trump. And so what does this all mean for where we are? One little bubble, and this bubble believes, and they just believe that much like you or I would believe that it's sunny outside right now, which it is. And so why wouldn't they, in their own subconscious way, well, you know, we've hiked a lot and inflation on this particular metric has come down and we need to take a little bit of insurance, we need to recalibrate policy, and so it's besides the point. They're going to cut this year. They're not going to cut too much, because if you cut too much, you actually end up leaving fear in the market about, wait, hold on a sec, what does the Fed know? And that would actually have the opposite effect. So I could very much see a